Hey everybody, Smart Silver Stacker here. Hope you're doing well. Yesterday, the Bureau of Labor Statistics released the inflation data for December, and according to that data, inflation actually fell in December by 0.1%. Now, is inflation really falling? And if so, what does it mean for gold and silver? Well, that's what we're going to talk about in today's video, so let's get to it. Okay, so is inflation really falling? Well, if you believe the official numbers from the Bureau of Labor Statistics and you believe the CPI, then yeah, inflation went down 0.1% month over month in December. But here's the thing, the CPI does not paint an entirely accurate picture, and there's two reasons. Well, the first one is that the CPI, we know, they massage the data, they have all these tricks, they have hedonic adjustments, the way they calculate housing costs. They don't really use real rents, they use owner equivalent rent. They have all these tricks to understate inflation. And the CPI calculation has been modified many times over the years to understate inflation. It makes it easier for the Fed to get away with all the money printing that they do. And in fact, they're actually going to be reformulating it again soon. So next month, when we get the inflation data from January, they're going to be changing the methodology from looking at 2 years of data to only looking at one. And I suspect that this will make it easier for the Fed and the Bureau of Labor Statistics to downplay inflation even further. Now, the second reason is that the core CPI for December was actually up, and that's the inflation numbers that exclude food and energy. Now, food actually, according to the official numbers, even got more expensive in December, but the downturn in the price of energy and gasoline was sufficient to give us that negative 0.1 number. But if you exclude those two things, food and energy, prices actually rose, according to the CPI, by 0.3%. So they probably were actually up a bit more than that. Now, what we really have going on right now is not falling inflation, but we have disinflation, and that is inflation still moving up, but at a slower pace. But it's important to keep in mind here, the damage has really already been done. I mean, we've already had a significant period of rising prices. So now, even if they continue to move up at a slower pace, they're moving up from an elevated level. And so consumers are absolutely going to continue coming under a lot of pressure from rising prices. There's no mistake about that. I mean, what we really need, if we want to take some of the pressure off the American consumers, we need deflation. We need falling prices. And of course, all these economists at the Fed, these Keynesian economists, they're going to tell you that deflation is the worst thing that can ever happen in an economy. But I don't know about you, I would be okay if prices began to fall. I don't think that that would hurt me personally economically at all. Let me know what you think in the comments down below. How do you feel about deflation? Would you be okay with falling prices? But regardless of how accurate the CPI data is and what's actually going on with inflation, the metals, we can take a look at the charts for both gold and silver from SD Bullion, channel sponsor. Check them out with the link down in the description. And you can see that both metals are reacting very positively to this report. Gold now well over 1,900 bucks, silver back up over 24 bucks and continuing to rise. Pretty good day in the markets for gold and silver. Now, why? You would think that lower inflation would be bad for the metals, right? I mean, gold and silver are commodities. You would think that their price would be falling if inflation was falling. Well, I've mentioned it before, and I'm sure I'll have to mention it again, but we live in a broken economy, a broken market. And the reason is that the Fed, they've been manipulating these markets for decades now, really about 2 decades, ever since the dot-com bubble popped at the end of the 90s or the beginning of the 2000s, I'm not sure what you call them, the 2000 aughts, I guess. The Fed has been keeping interest rates artificially low, trying to stimulate the economy. And all they've really done is they've reinflated these asset bubbles. And now they've broken markets so badly that the only thing that drives the prices for precious metals and just about everything else in these markets is the anticipation of what the Fed is going to do next. That's how addicted these markets are to the easy money provided by the Federal Reserve. And you can see that in the charts of gold and silver. I mean, really the rally that we have seen from the lows of last year in September for silver and in around November for gold, we've seen a significant rally in both metals since that time. And that all started when the rumors started to circulate that the Fed might do this kind of soft pivot, not a pivot in the sense that they have returned to reducing interest rates, but they have slowed their pace of rate hikes. And now, following yesterday's data, it's looking like the Fed may continue to slow down the pace of rate hikes. If we take a look at the CME FedWatch tool, which gives us an idea of what markets are anticipating in terms of the next Fed FOMC meeting, you can see that there is now only a 5.8% probability of a 50 basis point rate hike, and the vast majority of market participants are anticipating a 25 basis point rate hike. And the Fed is pretty much in the business of delivering to these markets what the markets expect. So I do believe that in February, that is what we are going to see. We are going to see another slowdown in the pace of the rate hike. So the Fed's still going to be hiking rates, but they're going to be hiking them less. Now, the real question here is how long will the Fed continue hiking rates at all? Because they've talked a pretty good hawkish game. They talk about terminal rates somewhere around 5%, possibly higher than that. And we continue to see a lot of hawkish commentary from the Fed. And what they're really doing there is they're just trying to manage inflation expectations. The Fed thinks that printing money isn't what causes inflation. They think that it's investors, they think that it's wage increases, they think that it's pretty much anything but themselves that's to blame for inflation. One of the things that they believe is that if investors think inflation is going to go higher, then inflation is going to go higher. So, that's the reason that we see all this hawkish commentary from folks like Jerome Powell and Neil Kashkari and all these other folks over at the Fed. But the reality is that these rate hikes, they cannot persist for too long. And eventually the Fed is going to be forced to do a real pivot where they return to an easy money policy. Now, the real reason for that is there's one very big reason, or you might say that there's 31.5 trillion reasons, and that is the U.S. debt, which continues to move up at a record pace. You got to think about the fact that it took something like 200 plus years for the U.S. to accumulate the first $1 trillion of debt. And today, we're racking up almost $1.5 trillion in debt on an annual basis. And I think in 2023, we might hit the $2 trillion mark for the U.S. deficit. But the reason that the Fed can't keep hiking rates, it is the massive debt, because eventually, all this debt that the U.S. has issued, it's not on 30-year treasuries. A lot of it is on shorter-term stuff. And so let's say that the Fed keeps hiking rates, or they keep rates high for another year or two. Well, eventually, that debt is going to get rolled over at these higher rates. And think about it, if the terminal rate is, say, 5%, if the U.S. national debt gets rolled over at 5%, well, 5% of $31.5 trillion, and growing, keep in mind, by the time that happens, the debt will be even higher than it is today. But even at just today's level, that's more than $1 trillion a year just in debt service. So you're talking about interest on the national debt becoming the biggest item in the federal budget, next to maybe Social Security and Medicare, but it could even eclipse that. So that is not a sustainable situation. So eventually, more stimulus, more easing, more rate cuts, they're all baked into the cake at this point, maybe even more QE. In fact, I believe that is going to happen. Unless you believe that somehow the U.S. government is going to slash the budget. If they're going to balance their budget, they're going to start paying down the debt with tax revenue. If you think that they're going to cut Social Security benefits and cut Medicare benefits and cut the defense budget, stop passing record defense budgets every year, stop sending all this money over to Ukraine. If you think that's going to happen, then maybe possibly we could get out of this without more easy money policy from the Fed. But I don't think there's really any chance of that happening. It's certainly less than 1% chance that that's going to occur. Leave me a comment down below if you think differently. If you think there's a way for the government to balance the budget and get this debt under control without, inflating the currency away and paying it off in devalued dollars, please do leave me a comment down below and let me know what you think, the path out of this debt nightmare really is. But at this point, I think that both parties have proven that they are absolutely willing to expand the debt, expand spending, grow government programs massively, and destroy the currency in the process. Because, I know a lot of folks who watch this channel leave me comments saying, it's Joe Biden's fault. And certainly he is not making the problem any better. There's no doubt about that. But I can't think of a time when the Republicans have been in control of government spending that they have done much to fix this problem. They pay a lot of lip service to it when they're not the ones in charge, but when it comes down to it, they don't do much to fix this problem. And it's kind of like Michael Berry recently tweeted. He said, inflation peaked, but it's not the last peak of this cycle. We are likely to see CPI lower, possibly negative in the second half of 2023, and the US in recession by any definition. The Fed will cut and the government will stimulate, and we will have another inflation spike. It's not hard. And I agree with him. We may see inflation numbers continue to drop. It's absolutely possible. Basically, what's going on is the Fed has destroyed demand in the US by impoverishing everybody with these rate hikes. But I don't think that that is going to ultimately be an effective way to fight inflation for the reason I already stated. The massive debts are enough of a reason to cause the Fed to eventually have to relax monetary policy, possibly even monetize a large portion of the debts by coming out with more QE. And that is why I am still trying to protect my purchasing power by accumulating hard assets like gold and silver. It's not financial advice, but if you want to protect your purchasing power, you might want to consider it too. So leave me a comment down below to let me know what you think about everything I covered in today's video. Thank you so much for watching, everybody. Stay safe and happy stacking, and I will catch you next time. Smart Silver Stacker, out.